Why Thomas Jefferson died broke, the housing trap. The man on the $2 bill, you know the face. It's on the nickel, it's on the $2 bill, it's chiseled into the granite of Mount Rushmore. Thomas Jefferson, the author of the Declaration of Independence, the third president of the United States. The man who doubled the size of the country with the Louisiana Purchase. A polymath, an architect, a philosopher. By all accounts, Thomas Jefferson was one of the greatest geniuses to ever walk the earth. But there is a dark secret that history teachers love to skip over. A secret that doesn't fit the narrative of the American hero. When Thomas Jefferson died on July 4, 1826, he wasn't living in glory. He was living in a nightmare of anxiety and creditors knocking at his door. Thomas Jefferson died insolvent. He died with a debt equivalent to millions of dollars in today's money. After his death, his family didn't inherit a dynasty. They inherited ruin. They were forced to auction off his furniture, his beloved books, his land, and tragically, 130 of the enslaved human beings he owned, separating families just to pay off the banks. How is this possible? How can a man smart enough to design a nation be stupid enough to lose everything? Was it gambling? No. Was it a Ponzi scheme? No. It was something much more common. It was the American dream before it even had a name. Thomas Jefferson fell into the real estate trap. He was the original victim of being house poor, in the terrifying part. 200 years later, millions of Americans are making the exact same mistake. They are buying homes they can't afford, filling them with things they don't need, and calling it an investment. Today, we are going to dissect the financial autopsy of Thomas Jefferson to prove to you that your primary home is not an asset. It is a liability that can destroy you. The Monticello obsession. Let's get into the drama. Let's talk about Monticello. If you go to Virginia today, you can visit it. It's a masterpiece of architecture, a neoclassical mansion sitting on a mountaintop. It looks like wealth. It looks like power. But to Jefferson, it was a bottomless pit. Jefferson inherited the land and some debt from his father. A smart financial move would have been to pay off the debt, build a modest house, and focus on the profitable farming of tobacco. But Jefferson didn't want modest. He wanted a palace. He started building Monticello when he was 26, but he was never satisfied. He went to France as a diplomat and fell in love with European architecture. When he came back, he literally tore down parts of his already expensive house to rebuild them in a French style. He was obsessed with renovations. He spent 40 years building, tearing down, and rebuilding this house. He installed the first automatic doors in America. He built a dome room that was practically useless but looked cool. He imported massive glass windows from Europe that cost a fortune. Does this sound familiar? This is the 18th century version of the guy who buys a house and immediately takes out a home equity line of credit to remodel the kitchen with Italian marble, even though he has no savings. But it wasn't just the bricks, it was the lifestyle. Jefferson loved wine. He didn't just drink wine, he imported the finest vintages from France. His wine bill alone during his presidency would be over $300,000 in today's money. He entertained guests constantly. People would show up at Monticello and stay for weeks, eating his food and drinking his wine. He was too polite to kick them out. He was financing a billionaire lifestyle on a politician's salary. He was borrowing money from British banks and Dutch lenders to pay the interest on previous loans. He was robbing Peter to pay Paul. By the end of his life, he was so desperate that he petitioned the Virginia legislature to let him hold a lottery. He wanted to raffle off his land just to pay his debts. Imagine that, an ex-president trying to run a lottery because he couldn't pay his bills. The lottery failed. He died thinking his daughter would be left on the street. All because he loved that house more than he loved financial freedom. The definition of an asset. Why he failed. Jefferson made one fatal calculation error. He confused value with cash flow. He looked at Monticello and said, "This is a valuable estate. I am rich." But the bank doesn't care about the columns or the dome. The bank cares about cash. Here is the lesson that Robert Kiyosaki made famous, but that Jefferson learned the hard way. An asset puts money in your pocket. A A liability takes money out of your pocket. Let's apply this test to your dream home. Does your house pay you on the 1st of every month? No. Does your house ask for money? Yes. Constantly. The mortgage. The biggest check you write. Property taxes. In places like New Jersey or Texas, you are essentially paying rent to the government forever. If you stop paying taxes, they seize your house. So do you really own it? Insurance, it goes up every year. Maintenance. A new roof is $15,000. A broken HVAC is $8,000. Termites? Floods? HOA fees, paying $400 a month for someone to tell you what color your grass must be. Monticello was the ultimate liability. It required an army of enslaved workers, constant repairs, and heating for massive rooms. It was a cash-burning machine. Jefferson was asset-rich, cash-poor. He had a net worth on paper, but he had negative cash flow. And cash flow is what keeps you alive. When you buy a big house to live in, you are not investing. You are engaging in consumption. You are buying a luxury good, like a yacht or a Ferrari, that you happen to sleep in. The amortization trap, the modern scam. Now, let's leave 1826 and come to 2025. You might say, well, I'm not building a palace. I'm just buying a normal suburban home. That's smart, right? Let's look at the math that your real estate agent is praying you never understand. It's called amortization. Let's say you buy a $500,000 home. You put some money down and take a $400,000 loan at a 7% interest rate for 30 years. Your monthly payment for principal and interest is roughly $2,060. You write that check and think, I am paying off my debt. I am building equity. Wrong. Look at the breakdown of your first payment. Out of that $2,060, $2,333 goes to interest, the bank's profit. Only $327 goes to principal, your equity. For the first 10 years of your mortgage, you are basically renting the money from the bank. You are barely touching the debt. If you stay in that house for the full 30 years, you won't pay $400,000. You will pay roughly $960,000. You bought one house for yourself, and you bought a second, nicer house for the bank executive. And this doesn't even include taxes and insurance. When people say, my house doubled in value in 20 years, they forget to subtract the massive interest they paid to the bank, the inflation that made the dollar worth less, the property taxes they paid every year, the new roof and the kitchen remodel. When you run the real numbers, most primary homes barely break even. They are forced savings accounts with terrible returns. Opportunity cost, the road not taken. This is where the tragedy of Jefferson hits the hardest. Jefferson was a brilliant man. If he had taken the money he poured into Monticello and invested it in productive ventures, shipping, early manufacturing, or simply paying off his debts to compound capital, he would have died the richest man in the Americas. This is called opportunity cost. Every dollar you bury in the drywall of your house is a dollar that is not working for you in the market. Let's go back to our example. Imagine you have $100,000 cash for a down payment. Option A, you buy the house. That $100,000 is now trapped. It sits there. It earns 0% cash flow. You have to pay to maintain it. Option B, you rent a nice place. You take that $100,000 and invest it in the S&P 500, which historically returns 10%. In 30 years, that trapped down payment in your house is worth whatever the housing market says. Maybe it doubled. But that $100,000 in the S&P 500, with no extra contributions, would grow to $1.7 million. Liquid. Available, yours. By tying up your capital in your home, you are sacrificing millions of dollars in future wealth. You are trading freedom for a white picket fence. Conclusion. Be smarter than a founding father. I am not telling you to be homeless. We all need a roof over our heads. And I am not telling you that real estate is bad. Real estate is amazing when others pay for it. If you buy a rental property where the tenant pays the mortgage and you keep the profit, that is an asset. That is genius. But your personal home, that is a luxury. If you want to buy a house because you want stability for your kids, or you want to paint the walls purple, or you want a backyard for your dog, go ahead. buy it. But be honest with yourself. Admit that it is an expense, not an investment. Admit that you are consuming wealth, not building it. Don't be like Thomas Jefferson. Don't let your ego write checks that your bank account can't cash. Don't build a monument to yourself that becomes a prison for your finances. The strategy for 2025 is simple. Rent where you live. Keep your expenses low, keep your mobility high, and use your cash to buy assets that actually pay you. Stocks, Bitcoin, businesses, or rental properties. Build your fortune first. Buy the mansion later. Thomas Jefferson couldn't do the math. But now, you can. Class dismissed. Subscribe for more, and thanks for watching, Jedi.